Have you ever wondered whether you're spending too much? Or for some of you, have you wondered whether or not maybe you can afford to spend just a little bit more and enjoy life a bit more? Well, if you are, stay tuned to this week's episode of the Retirement Income Source, where it truly is all about the income. Welcome to this week's episode of the Retirement Income Source, where it's all about the income. I'm David Scranton, here with Sarah Samuels, and we have a lot of newsworthy things to cover on this. Essentially, what we're approaching this third anniversary of our shutdown here in the United States of America due to the pandemic. What stayed the same? What's changed? Inflation, and again, to answer that also important question, hey, are you spending enough money? Are you spending too much money? All right, do you need to cut back now in this post-pandemic environment? And Sarah, I don't know what you did this weekend, but you probably didn't have as much fun as me because we spent 3 days down in Miami. Actually, I guess 4 days, try to stretch it to a long weekend. And I will tell you, there's no shortage of people out there in Miami trying to have fun, trying to party, maybe trying to make up for being shut down for a while. And they seem to be spending money.
Yeah, that could definitely be it, Dave. I mean, it's hard to believe it's really been 3 years since COVID got started, and a lot of places are just kind of coming out of the lockdown, even though Florida, it was a little bit different for us here in South Florida as we kind of went back to normal, if you will, like May, June 2020. But no, my weekend was not as much fun as yours. We didn't really do anything. We stayed home and kind of just enjoyed relaxing and doing things around the house. But
I knew I had more fun than you.
You definitely did. But I know you also spent a lot more money than I did, too, if you were down in Miami.
Yeah, it's not cheap down there. And it's interesting because, think about the last week in February was about when it became politicized or really announced in the news in the United States about the pandemic. At that point, up until that point, it had been international. And then within a month, we shut down. But, it's interesting. You would think that Florida, then, if we were more open along the way, we weren't shut down as much, you'd think there wouldn't be that much pent-up energy. But what I saw this weekend was there was indeed a lot of pent-up energy for people to go out, spend time together in groups, have fun, go to group events. Hardly a mask was to be found anywhere, right?
Right.
So we're still in this post-COVID world a little bit. And I think that's why January's inflation numbers came out hot. The last half of last year looked good. January's numbers came out hot. But, 1 month doesn't make a year, so I wouldn't draw conclusions right away. Yeah. But, consumer is persistent in terms of spending money. And therefore, why I want to talk today, Sarah, about, how do you know if you're spending too much money or how do you know if you could spend more?
Yeah, well, that's a great way to get into our Ask Dave question, I think. Sure. We have Cody from Arkansas, and Cody is asking the question of the show, right? He says, Dave, how do I know when I'm spending too much money in retirement?
In retirement. Okay, well, I'll answer that question in retirement there, Cody. So, first of all, we always talk about the fact that when you're retired, you're not worried about how much money you're saving. So it's a little bit of a different story. If you're younger, you'd have to answer that question. You have to factor in, gosh, am I saving enough money for retirement, right? But you're retired, that's not the case. So the simple answer is if you're spending your Social Security, your pension income, if you're blessed enough to have such a pension, the old-fashioned type pensions, and if you're living off just the interest and dividends on your investments, then at first glance, you're okay. You're okay. But Cody, it also depends upon how old you are, right? Because if you're in your 60s, you have to worry about future inflation in retirement more than you do in your 80s. Yeah. If you're in your 80s, you can probably get away with spending, or even late 70s, maybe spending all of your interest and dividends, all your income from your investments, and it's not a problem. But if you're in your 60s, you may want to spend a portion and reinvest a portion. Because chances are you're invested, hopefully, fingers crossed, you're investing more conservatively than you did in your working years, which means that you're not going to have as much growth or upside potential in your investments, which means that you've got to grow your money the organic way through reinvestment of interest and dividends, which means you shouldn't be spending all of your interest and dividends if you're at that point. And Cody, we're going to talk about that a little bit more coming up in this show.
And Cody, thank you so much for sending in your Ask Dave question. And if any of our listeners or our YouTube viewers out there have a question that you want Dave to answer, just send us an email at askdave@retirementincomesource. That's SOURCE.com. And you're listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with the host, David Scran. And today we're talking about this really important question. How do I know when I'm spending too much money? We just saw the recent inflation report report. It came out last week showing that inflation is still a little bit high. I think we'll even increase about 0.5% from the month before. I know Dave hates this number. He'll probably complain about it, but we're looking at a 6.4% year over year from the past month.
You have to do that to me, don't you?
I know the media does it. That's the media, the number that people are familiar with.
I'm having a nice weekend, so I'm trying to keep calm, and you're trying to get my blood pressure up, Sarah.
I'm
Why
sorry,
do you have
Dave.
to
I
do
hate
this?
to do it to you, but that's the number people hear, so I want them to understand it.
Well, now you know enough about why that's a number that's really not applicable today, right?
I do. But I think you should explain it just in case if people, that way they understand.
I think you keep bringing it up. You should explain it's what I think. But no, seriously, it's because you go back 12 months at this point, you're factoring in February through June of last year when rates were really, really high. And we know through the second half of the year, the cumulative inflation through the second half was about 1%, a little less, which compounded to a 2% annualized inflation rate. Now, January is higher, but it's just 1 month. But Sarah, I want to talk a little bit about where we're seeing inflation, and this could be good or bad, and I'm sure our listeners can relate to some of this, is that, this is quarterly earnings season for corporate America. So if those of you don't know, this is the time of year where all the corporations come out, they announce how they did in the previous quarter, their revenues, their profits, where they outperformed estimates, where they underperform estimates. And what's happening is companies that are selling goods, material things, are feeling more pressure. They're a lot of times their revenues are getting pushed downward. In some cases, the revenues are up, but their profits are down. And the only reason the revenues are up is because things cost more, right? But their profits are down because the cost of raw materials went up, the cost of labor went up. So they're feeling a lot of pressure, and they are feeling some pressure on the demand side for goods and services, for goods rather. But for those service-oriented companies, this quarterly earnings report, Sarah, they're finding the opposite. They're finding that there's incredible demand. So cruise ships, airlines, hotels, those are packed way in advance. And I can tell you from just looking at the amount of people in our hotel this past weekend, it was crazy. So people are shifting from buying things to buying, to spending money on experiences. Yeah. Now, that could be good or bad, right?
Right. Well, explain, Dave. Tell us, how can it be good and bad? It's like a double-edged sword almost.
Yeah. Well, this is common oftentimes when the economy starts to slow down, because a lot of times when people are buying goods, they're buying goods on installments, right? So they're making a long-term commitment. And when people are questioning the economy, they don't want to make that long-term commitment to make payments for cars and for houses,
right, like
or
financing
for boats.
Something, right?
That's right. They don't want to make that long-term commitment. But spending money on a weekend, that's different. Or spending money on a cruise, it's a one-time expense and it goes away. So people feel more comfortable spending money on experiences than things, large ticket purchase items, when the economy starts to slack. Yeah. The negative, though, is if they're not paying for it out of income, if they're not paying for it out of cash, right? Because at least if you're financing a major purchase, you're getting long-term favorable interest rates, favorable payments. If you're putting that cruise on your credit card, you're putting that long weekend in Miami on your credit card, right? All of a sudden now that can get financed at much higher interest rates. So if you can't pay that off, if you're just doing, hey, let's have one last hurrah in this great experience, post-COVID-19, then you're going to be paying much more for it in terms of interest. So, and that's what I saw in Miami, right? I saw some purchases at the art show, but at the boat show, I didn't really see that. At the boat show, I felt like the major purchases have just slowed down a lot. So, in fact, Sarah, coming up, I want to talk more about that, talk more about inflation, where things are headed. And we talked a little bit about how to protect yourself from inflation if you're retired. But coming up, I also want to talk about how to protect yourself from inflation if you're not retired yet.
I'm Sarah Samuels, and I'm here with Dave Scranton, and you're listening to The Retirement Income Source, where it truly is all about your income. You're listening to The Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with my good friend and our host, David Scranton. And on today's show, we're answering this important question: how do you know when you're spending too much money? We've also talked a little bit about inflation with the recent inflation report that came out. And so now, Dave, I want to ask you, how can you really inflation-proof yourself while you're still working?
Well, that's an interesting question, Sarah, because when you're working, it's a little bit offense and defense, right? So part of it is trying to add as much value as you can with your employer, so that you can become more valuable and you can get pay raises or bonuses or things like that. So part of it's offense. And, again, in this environment where we could be tinkering on recession, labor market's really strong, but you never know. That could flip in a heartbeat.
Yeah.
The important thing is to approach it the right way. And a lot of people sometimes approach their employer saying, well, I need to make more money. My bills have gone up.
Which I feel like is really not the right way to approach your employer.
That's right.
To say, hey, I'm having a personal problem, right? I took out this big loan. I got a nice fancy car, Dave. I'm going to need a raise.
That's right. That's not the way to do it. It's, hey, how can look, I'd like to make more money. I'd like to be more valuable to the company. What can I do to become more valuable so I can earn more? And that's the message that typically resonates with most employers. So part of it is offense. But the second part of it is defense. So it's consolidating loans wherever you can. It's paying off debt so you have more cash flow. We've talked about how in our whole household, and as well as your household, you and Justin, right, how periodically you go through periods of austerity, right, where you say, okay, we're now going to think about all the expenses we can cut back every couple of years.
Oh,
Do I really need this membership anymore? Do I really need a subscription anymore? And you cut back, and every couple of years you can save $100, $200 a month, and it may not seem like much, but it adds up, right?
It adds up, exactly. And you can save a lot of money over time. And I really think that all households or even single people should do this. Just kind of do a quarterly review even or every 6 months, whatever works for you. But really look at those things because you will forget about all those random video streaming services you've subscribed to. They have all kinds of snack subscriptions. They have everything now.
That's right, yeah. Subscription for, that's right. For just about everything. Well, it's funny because you can, the other thing too is it depends with whether you own or whether you're renting. See, if you own and you have a mortgage you locked in more than a year ago at 3 or 4%, well then inflation isn't affecting you as much as it is other people because, yeah, your expenses have gone up, but your mortgage hasn't. So that's helped you.
Yeah.
Or any other fixed payments that you might have helped you. Now, ironically, you say, well, what if I'm renting? Right now, rental costs are going through the roof. It's a challenge. So you might say, well, this isn't the time to buy property, right? Mortgage rates are 6, 7%. I don't want to buy right now. Well, it depends how much you can afford the payment. See, if you can get a good deal on a property right now, and in most parts of the country, it varies, right? But in most parts of the country, you get a better deal than you certainly could a year ago.
Right. Mm-hmm.
And if you can do it to a way where you can afford the payments, where you're not stretching, right? Now it's a bit of a gamble. But yeah, you might get a better deal on a piece of property and lock in your payments at a high interest rate, right? So you may not feel like it's a great benefit, but interest rates are going to come down. Interest rates aren't going to stay this high forever, and there'll be chances in the future maybe to refinance at 5% or 4% or even lower. So again, it's a bit of a gamble that rates are going to come back down again, but sometimes you need to zig while others zag. And if you're having a tough time making the purchase commitment right now because, gee, the mortgage rates are high, it might be the reason it's actually a good time. And you make higher payments for a couple of years and then you refinance. Or, Sarah, you get in one of those loans where maybe you have a reduced rate the first 3 years or 5 years or 7 years. And then it resets to a variable rate after that. And then, sometime in the next 3, 5, or 7 years, you have to refinance. So again, there's different ways to do this to even lock in, the skyrocketing rental costs that people are experiencing today.
I don't think it's a bad idea, Dave, especially when you look at some rental costs are even higher, much higher than you might pay for a mortgage note each month. So let's turn to our Ask Dave question. So this is our Ask Dave. We have Rebecca from California, and she says, I'm not yet retired, but how do I know if I'm saving enough money?
All righty. Well, if you're not yet retired, well, the best way to do that is to, first of all, figure out what your retirement goals are. And I'll talk about that a little bit more later on in the segment. But, figure out what your retirement goals are and try to back into how much money you need in retirement. Because if you can back into how much money you need in retirement, then to me, I think it's easier at that point to say, okay, now how much am I saving? Am I saving enough to get there or not? And, because really, to answer the question, Rebecca, gee, am I spending too much money today or could I spend more? Really, if you're working, it doesn't depend upon, gee, am I spending all my interest and dividends? Because you're not spending the interest and dividends. You're reinvesting it. You're growing your money, right? But also doesn't mean, gee, am I spending all my income from work? So the key is that you're saving and investing enough to hit your goals. Then you could spend the rest with a clear conscience. So it's the old adage, if you pay yourself first, right? The first check every pay period, metaphorically speaking, should be to you, to your savings and investment account. Yeah. And then after that, you spend the rest with a clear conscience, knowing that you've done what you promised yourself you would do for the future.
I hope that helps, Rebecca. And if any of our other listeners or our YouTube viewers out there have a question that you want Dave to answer on a future show, all you have to do is email us at askdave@retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it truly is all about the income. Today, we're talking about the recent inflation numbers, ways to make sure that you're saving enough, making sure you're not spending too much money. And Dave just answered a really good question from Rebecca out in California. And Dave, you mentioned you really want to back into what your monetary goal is. But first, you have to figure out what your retirement goals
right,
are.
what you want in retirement.
Right. So how do you do that?
So it depends. If Rebecca's 25, it might be a little difficult because, gosh, who knows what she's going to want to do 35 or 40, 45 years later. If she's closer to being an empty nester, assuming she had children, or if not, at least late 40s, maybe into 50s. Now you tend to have a better vision as to what you want to do. But it doesn't mean even if you're in your 20s, you shouldn't start. You need to create that vision. And with what's happening lately, that vision is changing, right? Maybe before COVID, that vision was to have a house in the mountains and have a house in the ocean, right?
Yeah.
Now the vision, with all the prices going up or interest rates going up, the vision might be different. It might be to do more things, to experience more things, because depending upon what state you lived in, right, as you indicated earlier, you might have been unable to do anything for 2
years, right? You might have been locked down pretty much.
That's right. That's right. So it's we were just in New York, and I was in New York for the first time, Sarah. For those who don't know, we were in New York last Friday actually, and we were ringing the bell for the New York Stock Exchange at closing bell. Our company, Sound Income Group, which is a great honor. Never done it before. It was great to be there. Sarah, it was great to have you there too with us.
Oh, it's a great opportunity. It was so much fun.
It was a lot of fun, but it was the first time I'd been in New York City since the pandemic started, and the reason was because to me it was so restrictive. There were so few things you could do that I just didn't want to go. It didn't feel like fun.
Yeah.
Yeah. And maybe that's why when we all went there and we stayed overnight, we got hotel rooms in the city for $169. I mean,
it was really affordable. I was surprised at the nice rooms we got and the great pricing. But
it was crazy. But I think it was because again, I think people are just starting to warm up that New York City's open again. We can get back to it. So I the key here is to take time to envision. Getting back to our topic, right?
Right.
You got to reel me back in sometime.
Reel back in. We got excited talking about our trip.
That's right. It was great. How it's only once in a lifetime you get to ring the bell at the New York Stock Exchange, right?
And maybe we can even put in the video of us doing that, Dave, for our YouTube viewers so they can see it in case they missed it.
Oh, it was awesome. I know we should.
Yeah.
So, but first thing is figuring out what retirement looks like for you and creating some target and making some reasonable assumptions and backing in how much you need to save to get there with some reasonable assumptions. And unless you're very mathematical, you probably want to work with a retirement planner to do this. I always say, when you get close to retirement or in retirement, you need to stop working with a retirement planner and work with an income specialist. But if you're younger, you need to work with a retirement planner who can help you calculate these numbers and plan out the future.
Yeah.
So you can say, hey, this is how much I need to save to hit what I think my goals in retirement might be 30, 40 years from now.
Right. Well, when you're a lot younger, Dave, as you always mentioned, you have a lot more time to make up your loss in the stock market versus you're closing in on retirement. You really don't have that time to make it up. So, well, coming up, we are going to actually inflation-proof yourself if you've already retired. You don't want to miss that.
That's right. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the income.
Welcome back to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with my good friend Dave Scranton, and today we're talking about inflation, the inflation report, ways that you can inflation-proof your retirement, and really some more tips to kind of help you deal with these inflation numbers, Dave.
Yeah. No, it's a great topic because we predict inflation going back down. I've been saying this for a long time.
Yep, you
have.
It
looked good second half of last year. January, not so much. But like I say, one month doesn't make a year, so I have to see. But, I think it's most important for our listeners to know that, hey, nobody has a crystal ball. So regardless, you have to protect yourself against inflation. So let's focus on retirees, right? A lot of our clients are retired. What do you do in retirement? So even if you're a few years out of retirement, this is good information so you can start to plan ahead as to how to protect yourself against the dreaded I word, right? Inflation in retirement.
Right. And inflation is a huge thing because it affects everybody, Dave. Retired people, people that are still working. It really affects everyone. So I think it's important to share these tips.
It's like high blood pressure, right? It's called the silent killer in the medical field.
Absolutely.
Well, inflation is kind of like the silent killer, in the financial world, right? You can have 100,000 of income, and see, when you're working, you can kind of expect that hopefully your income will go up at some rate commensurate with inflation. And as I said before, even if your income doesn't go up with the CPI index increases, the cost of inflation, you probably have a mortgage, which is a fixed payment, maybe a car payment, fixed payment. So what you feel the effects of inflation are a little bit less. But when you're retired, there's no employer to go to and say, hey, how can I become more valuable so I can earn more money, right? It doesn't happen. When you're retired, you hopefully don't have a mortgage anymore. It's paid off. So
ideally.
So all your expenses go up with inflation, right? So, and you want to do more fun things, the things, like we said, the experiential things, which have a higher exposure to inflation. So retirees get hit really hard with inflation, not to mention medical expenses, right? Medical expenses, we always talk about, go up at almost double the inflation rate, the regular inflation rate.
Healthcare is through the roof, especially. I think it's double every couple of years. It doubles as opposed to regular inflation. Which, when I first heard that number, Dave, I was shocked. It was really surprising to me. But now that my parents are looking for healthcare for my grandmother, it's crazy what they're charging. So it's a killer.
It's expensive. Whether it's regular healthcare, whether it's home healthcare, whether it's you talk to any doctor today and they say how they're getting squeezed, right? Medicare doesn't want to reimburse as much, but yet their people need to get paid more, so the doctors are getting squeezed. I'm grateful I made the decision when I was pre-med not to go to medical school, because I just think you got to be more of a business person these days than a doctor. So you want to get in because you love helping people. It's great, but can you even make enough, unless you're a specialist, can you even make enough to pay off your medical school loans? And that's a big question. So inflation is a big deal for retirees, and we always talk, Sarah, about the biggest thing in inflation is to, reinvest some of that interest and dividend. Try not to live off all the interest and dividend. Try to reinvest it. But again, in retirement, a lot of it's also defense, right?
Yep.
So every year you want to shop your Medicare supplement programs. You want to shop and see if you could save some money there. And again, you've got to reevaluate your retirement goals every year, because you may have retired and thought your vision for retirement was to do certain things. And now, especially after the pandemic, you may have changed your mindset and now you want your retirement to look some different way.
Right.
So it allows you to save some expenses that in one area and maybe pick up some expenses somewhere else. So it's an ongoing thing, but inflation affects retirees more than anything else. So.
Absolutely. Well, it's a great way to get into our Ask Dave question. We have Marshall from Idaho, and Marshall's asking, shouldn't I have more money in stocks if I'm retired and I want an inflation hedge?
Marshall, great question. And the answer is yes and no. Okay. The traditional thought is that you need more growth. If you get more growth than by being in stocks, then that's what's going to give you the inflation hedge. And that's true, except for two things, Marshall. Number one, you can't count on growth. You don't know growth is going to occur, right? If you asked me this question in the year 2000, right? Back then, most advisors would say, well, yes, you need more in stocks, you need more growth. But the reality is, if you went fast forward 13 years, by 2013, you probably had the same amount of money you had in the year 2000, because you didn't get growth, right? You had two major drops in the stock market between 2000 and 2016, and the stock market basically ending up exactly where it started 13 years later. So the key, I believe, in the stock market is to use a high dividend strategy, because the dividend is the only bird in the hand, right? And you want to inflation-proof your future income, right? I don't think you're saying, Marshall, you want to make these great gains so you can go and cash it out in a lump sum and buy a bigger home or a second home or a yacht or something. You're trying to inflation-proof your income. So focusing on high dividend stocks is crucial. And by the way, the benefit to high dividend stocks, as you know, Sarah, is that it really lets you dollar cost average, right? When you're working, you dollar cost average, you put money in every month. So you bought more shares when the market's down, fewer shares when the market's up. That's why you may have recovered from the 2000 crash a lot quicker than retirees because you're working back then. But it's a different story now. So Marshall, those dividends allow you to reinvest in dollar cost average. So even if you don't get growth, your income in the future can still grow.
Well, Marshall, thank you so much for sending in your Ask Dave email. And if any of our listeners or our YouTube viewers out there have a question that you want Dave to answer, he might answer it on a future show. All you need to do is email us at askdave@retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels. I'm here with Dave Scranton. And today we're talking about ways to really get more out of your income, right? Ways to inflation-proof your income. Ways to inflation-proof your retirement, how to know if you've really saved enough money. So, Dave, why do you think people really struggle with this concept of saving enough money? Because I see all the time, every time I do research for our show, I see questions like, is $3 million enough saved? Is $5 million enough saved? Or I have $1.5 million in a nest egg. Is that enough money saved? So why do you think people are so obsessed with this nest egg number, Dave?
Well, I guess in some ways it's good, in some ways it's bad, right? Because it's good that people are focused on it. The people that scare me the most are the ones that say, well, I'm not worried about it. It's all going to work out fine, right? You have to at least start with a plan. Even though plans can fail, you have to start somewhere.
Right. You need something to start off, yeah.
Right. So you don't want to have that type of flippant arrogance, if you will. But also some people are so worried, so stressed about it that they can't enjoy their lives. They're saving too much. And this is where you get into people that are, maybe not willing to spend, right? So I think you've got to look at your income today, right? And say, okay, at bare minimum, if I'm making, X amount of dollars today, and I say I can take my savings, my nest egg, and generate 4% income, and along with Social Security and pension income, I'll replace today's income, then you at least have to say, okay, I'm doing okay. Everything else right now is gravy. It's the cherry on top. It's icing on the cake, right? Whatever metaphor you want to use, it's all extra because you can pretty much replace your income today. Now, if you go through that equation and you're within 10 years of retirement and you say, okay, I take 4% of my savings and investments as income every year. I add it to my projected Social Security and pensions, and it's half of my income, well, then you probably have to save more. You have to work a little harder. So, to me, you have to look at the income it can generate, not the lump sum. Because, Sarah, as you know, retirement is all about the
income.
That's right. That's right.
Well, Dave, like you just said, a lot of people are really uncomfortable with spending enough money in retirement. And I think it's really a psychological kind of thing that they have to go through this transition, which you always talk about, that transition and mindset when it comes to your investments. So if this sounds like you, if you're one of those people out there that is terrified to spend your money in retirement, then you don't want to go away, because Dave is going to share some tips to get you comfortable with spending your hard-earned retirement dollars.
And I assure you that's going to be fun. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the income. And welcome back to the Retirement Income Source, where it truly is all about the income. I'm David Scranton here with Sarah Samuels, and we've talked a lot today, done a lot of great things, focusing on inflation, focusing on helping you determine whether you're spending too much money in retirement or maybe you're just not spending enough. And Sarah, I really want to talk more right now about, what if you're not spending enough? But before that, I just want to go back to Friday at the New York Stock Exchange. If you're just tuning in, we mentioned a couple segments ago that we had a great experience. Our company got to ring the closing bell at the New York Stock Exchange last Friday. It's a once-in-a-lifetime event, pretty cool. But I saw a guy standing on the floor, Sarah, when you were there, and he was wearing dark sunglasses. And you think maybe that could have been George from last week by any chance? Could that have been George, your secret admirer?
Oh my gosh, it could have been, Dave. Do you think do you think George followed us all the way to New York?
I think George might have.
I didn't notice it.
Yeah, and for those of you who don't know who weren't with us last week, well, first of all, shame on you. But second of all, if you were with us last week, we found that our lovely lady here, Sarah, has a secret admirer who on Valentine's Day sent her flowers and chocolates. And You never found out who George was, right?
No, I never did. No one fessed up to it. It wasn't a friend, anyone playing a prank. So I think it was someone in our office, Dave. I have my my suspicions.
I think it was the guy on the floor on Friday with the dark sunglasses.
It could have been that guy.
But you know what really concerns me the most is you're in charge of all the Ask Dave questions, not me. And
That's
therefore,
true.
I don't know. So has George written in again? I asked for George to write in, and has George written in? Tell me the truth. Don't lie to me.
Nope,
Did you write in?
George hasn't revealed himself yet. So George, if you're out there and you're listening to the show, and whoever George is, you should let us
All
know.
right, well,
We'd love to know.
ladies and gentlemen, you can write in, and you could tell me whether or not I should believe Sarah here, because I think she might be more aware of the identity of her stalker, but is unwilling to disclose it. But okay.
All right, back to the topic, Dave.
That's right.
Yeah, we saved the best for last, really, because this topic, it's fun, right? It's how to get more comfortable spending your money. So, Dave, tell us, first, why do you think people are so uncomfortable spending money in retirement? Some people.
Well, it's because you go to work in your entire life, you're used to saving money, right? You get a paycheck, you save some, you spend the rest. Next week, get a paycheck, save some, spend the rest. But that paycheck's always coming in. You're used to going to work, earning money that way. And even though now, if you're following what we talk about every single week on the show, you're living off the interest and dividends, right? Not the growth, not selling shares, not trying to engineer income through the withdrawal method, right?
Yep.
Still, you feel like you're taking withdrawals, and you just don't feel comfortable, even though you're getting it from the interest and dividends. And you remember the story I had from a top executive in a major company in Hartford when I was just early in my career. He had $6 million. This is back when you can get 6% tax-free on municipal bonds.
Wow.
He was getting $360,000 of income tax-free.
Wow.
And he was only
Good
spending,
old days, right?
Yeah, he was only spending $150,000 a year, which back then, late 80s, was a decent amount. But still, he was able to reinvest more than half his interest, and he still was paranoid about pulling the trigger in retirement because he had to make a paradigm shift that he just had never done in his life. And he got me to realize that retirement isn't just about the math, it's about the psychology. It's about the fact that you're now changing where your income comes from. And for a lot of people, that just makes them feel uncomfortable.
Yeah. Well, it also reminds me of a couple shows ago we were talking about right after Bernie Madoff got arrested. You were out on Worth Avenue, which is like the Rodeo Drive in Palm Beach, and that you saw tumbleweeds. No one was out shopping.
That's right.
Even though these people could obviously still afford it. They're multimillionaires and billionaires. They were so freaked out by losing some of them half their money with Bernie Madoff that they were not out spending money. So
A lot of people say to me, you can have I've got a huge pension, huge Social Security. I can have all my money in growth. It doesn't really matter, but it does, because psychologically, even if you don't need that money, if you see your $2 million drop down to 1.25 or 1, you're not going to want to go out and spend.
Right.
But yet, when your accounts grew from 750 to $1 million or to 1.2 million on the upswing, you were out spending, enjoying it.
Right.
So that's how the human brain works.
Yeah.
It's not about the number of your net worth that makes you feel comfortable. It's about the direction. Are you growing or are you going backward? Right? People don't like to go backward.
No.
They like to go. They like to be moving forward and growing.
Yeah. Well, Dave, what if you want to spend money, but your partner is the one that's uncomfortable spending money? Because that's our next Ask Dave question we have here. We have Kayla from Alaska, and Kayla says, Dave, I'm comfortable spending our money in retirement, but my husband is so afraid. How do I get him to change his mind? Dave, tell us, how does she get her husband to change his mind? I would love to know.
Well, Kayla, great question, and it's been a good question, God, for this week, but also for last week for our Valentine's show, right? So part of it, it depends what your husband does or how he feels. But for example, if he's more mathematical, if he's like an engineer or more of a left brain career person, it's great just to show the numbers, just to show, look, if we can rebalance our portfolio to get more income, so you're not withdrawing principal, then would you feel more comfortable spending some money if it were a renewable resource, right? So Kayla, think about this. If you had to heat your home, and where's Kayla from again?
Alaska, so it is
Alaska.
cold.
Oh,
She's heating her home.
Okay. So if there were a law that said you had to heat the home based upon the wood on your property, you might be conservative because you don't know if some of the trees are going to die or how long you're going to live, and the wood on your property is a finite resource, right? But all of a sudden, if you said, okay, I'm going to heat my home with wind power or solar, although solar probably doesn't work so well in the parts of the year you need it in Alaska with the short days, right?
That's a good point.
But a renewable resource, then Kayla, we'd be in a position where you'd feel more comfortable cranking the heat up in your house because you knew there'd be more the next day. It's a renewable resource. So I think part of the key is showing your husband that if you can reallocate your investments to get more more income, then he can spend more without touching the principal. And to me, that's always the secret.
Yep. Enjoy your retirement, right?
You can enjoy it. You can't take it with you. That's right.
That's absolutely true. Well, Kayla, thank you so much for sending in your question, and good luck using Dave's tips on your husband. I hope it works. If any of our other listeners or viewers out there have a question that you want Dave to answer, all you need to do is email us at askdave@retirementincomesource, SOURCE.com. You're listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with our host and my good friend, Dave Scranton, as we're wrapping up our episode about inflation, spending money, saving money, getting comfortable spending money in retirement, and really why people have such a struggle when it comes to this part of the retirement, right? Like when they actually get to spend the money they spent decades, working for.
Right. Well, because your whole life you're saving, so you're scrimping, you're trying to, every time you had to buy a car, do I buy the fancy car or do I buy a more reasonable car so I could save more? Most people opted for the more reasonable car. Every time you go on vacation, extravagant vacation or more reasonable so I could save more. Well, you opted for the latter, not the former. So you got that in your DNA, and now that you've done it, you've gotten the award, but you're not you're not comfortable holding that award, holding that trophy, right? So it's important to get comfortable with it and to enjoy it, because like we said before, you can't take it with you.
Very good advice. Very true.
And the secret is making sure you have enough income, enough from the I, because if you spend the I, it's going to come back next year and the year after. So it's a lot easier. Reminds me of a guy that had a tough time spending, maybe like Kayla's husband, right?
Right.
But they had a pretty good net worth, and he loved collectible cars, right?
Okay.
And when it got down to it is, we joked about the fact that as men, right, imagine going home to our wives saying, honey, we're going to go take $50,000 or $100,000 out to go to a Barrett-Jackson auction or a Mecum auction like we did in January.
Right, yep.
And to buy this 40, 50-year-old car, right? That's a tough conversation.
Yeah, I don't know if she's going to go for that.
Right, but if you said, look, we have enough interest and dividends being generated where I can just take this year's interest and dividend or part of this year's interest and dividend and go ahead and buy the car, then I'm not touching the principal. And maybe next year we could take that interest and dividends, and honey, we could do something that you want, right? And when I said that to him, the light bulb went off, and he thought, wow, this works. And that's the power of income. So, and sometimes people say, Sarah, well, that's great. Well, if I have enough income, then I could take more risk, right? I could be in the stock market, and I could, and this goes back to our previous topic.
Right.
We could be in the stock market. Who cares if it drops as long as I'm living off the dividends? Well, both things matter, right?
Yep.
The income, the I, getting enough interest and dividends matters mathematically, so you're not spending principal. So you're only spending that renewable resource. But still, you have to worry about your losses on paper, because that matters psychologically. And even if you're getting the income, if you're just living off the I, like we said, like that Worth Avenue example that you mentioned, we might, people might not feel comfortable spending it, even if they don't need the principal, just because the principal has dropped. So like I said last week, a good friend, one of my cohorts in the Connecticut office says personal finance is at least 80% personal, and that's the personal side.
Yep. And that's really the why we do this show, Dave, and why you're always educating and out there talking to people, is we really want people to enjoy their retirement. You've spent all this time, all of this money that you've saved. It's time to enjoy it.
That's why we exist.
That's why we exist. And that's why we have Dr. Dave here to kind of help you with the psychological aspects of spending your own money. So thank you so much for watching. And if you enjoyed this show, we encourage you to share it with your friends. You can even watch the show all over again on our YouTube channel or on retirementincomesourceradioshow.com.
Yes, please share the show with everyone. But more importantly, we hope you join us next week. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the income.